What's going on, guys? My name is Justin McCray. Welcome back to my channel. Listen, today I want to talk about how the rich and the ultra wealthy avoid paying taxes, but how they do it legally. Let's dive right in. Okay, so you guys probably have heard this come obviously through the news and everything else, and you always hear it. Even when President Trump was in office, they made a big deal of the idea that he was paying only a couple $1,000s in his taxes. Listen, there's ways that people are doing this, and a lot of it is set up just the way you're getting paid, right? How you're being paid, how your companies are structured, and whether you're an employee, whether you're self-employed, or you run a large corporation, it directly impacts your tax liability, okay? And mostly, let's keep in mind, these are just the ways that the laws were set, and honestly, you can't, hate on people for taking advantage of the way the system is, and that's something to be said. But let's go into the ways people are paid and how that makes the taxes that you're paying a lot different than, let's say, individuals like Donald Trump, independent owners of businesses, and just overall entrepreneurs. But then how you can also help win that leverage over as well and do your best to avoid taxable income to the highest extent. And to kind of explain this a little bit better, I'll go to one of my mentors, Robert Kiyosaki. The cash flow quadrant makes a big example of the way this is structured. The way people earn money is what we're talking about. Start with number one, employees. Who are employees? These are individuals who work for a set salary. They're the majority of the American workforce. They are the pillar. So, these are individuals that don't have as much control over, obviously, their income, their taxes, their tax based on the bracket that they fall into. And honestly, a misconception is that, people say when you hit a bracket, they might think you pay that entire amount you've earned that year in that bracket that you're in. That's not correct. When you go over to a new bracket, say you're $5,000 over, you cross to a new bracket, when you make an extra, $5,000 in there, you're only gonna get taxed that highest amount at that $5,000, right? So you're taxed at the bracket you're in when you make that money, right? It just goes up and escalates for each bracket. So, and then you'll get the states, obviously that's a big factor too, state tax. California, New York, you see people fleeing these states, and they should, frankly, I would, for the tax shelters that you can go to for like Florida and Texas are really big right now. You see people fleeing and putting their businesses in areas that are more tax friendly to corporations and individuals, because there's no state income tax. So let's go down and kind of give you an example. So let's say, your example, you're earning $53,000 for the year. You're falling that 22% federal tax bracket. That means about $9,700 of your money will be charged at 10%. Almost $28,000 will be charged at 12%, while the rest charged at like the 22% bracket. But people in this group, really lower their income by putting in pre-tax money in the retirement accounts like Roth IRAs. You can do health savings accounts for college funds. You can really try to do pre-tax vehicles to allow to shield that a little bit better, and I highly recommend that. So let's go to the next one, self-employed individuals. All right, now in this group, they have more control over their taxes, and they can reduce, honestly, their liability mostly by writing off business expenses, for themselves, okay? However, there's a catch to this. You have to pay a 15.3% self-employment tax on top of that federal and state tax that you're at. So catch here, though, is that your employer typically, right, pays this out, whether you know this or not, but they'll pay this out. But in this case, you're an employer now, you're self-employed, so you're paying that not only tax for the employer side, but the employee side, you're paying both, okay? So to make it a lot easier to understand this, let's say, you're self-employed, you make $250,000, you make $250,000 for the year, straight away you have to pay around $55,000 in federal tax, while paying almost $23,200 in self-employment tax, and if you're in a high tax state or anything like that, you're paid additional $15,000 to $25,000, give or take, depending on the states you're in. But that's the advantage of going to a zero state income tax area, like we talked about. You'll be left, right off the bat with a big chunk of your income that needs to go straight to the government. Okay, it's a little harsh, but here's the thing. The way that self-employed individuals can benefit mostly is to honestly lower the tax bracket, right? Their liability by offsetting that with their business expenses, which honestly add up every single day. You're doing things all the time. You're buying stuff. You're constantly doing things, whether it's writing off, a portion of your vehicle and mileage, or it's, expenses in your home office and things like that you wouldn't think about it, but it adds up big time. So next one, let's go to this. This is the one we're really going to get to, is the businesses. Businesses is where it gets interesting. This is the areas like Donald Trump and things like that, these large corporations that can shield themselves the best. It's really the way how it's structured and they're setting up, how they can shield their taxes. And corporations can do this in many different ways. Okay, you hear it a lot. Sometimes they're headquartered overseas, but they do majority of their business here. It's a way that they're shielding this for it. But take example of Elon Musk and some of these other groups that are forward thinking. I mean, they can get research and development, tax cuts and breaks and things like that for also, their businesses. So there's so many different things that are going into this. But let's keep in mind, it's not just one company. I mean, they have probably hundreds of entities that are structured in a way to help shield taxes. So they're really trying to just do as much to leverage the system as possible, but in a legal way. Going back to Trump, I mean, like I said, businesses love Donald Trump's tax plan because it cut down from 35% to 21% as a corporate tax. And another way that these companies are saving money on taxes by offsetting profits by debt. So take a quick loan out, right? They get loans out to buy assets. Money is dirt cheap right now. Interest rates are low. Assets bought from debt have 0% tax on them. The debt is then paid off by the profits, which lowers your taxable income. So basically, converted your profit to asset equity, right, while paying next to nothing in taxes. So I mean, it's genius, but it's a way the system's set up. To be honest, another way corporations do this is that the owners, and honestly, this is how mine's set up as an S corp, my company, is that I take a modest salary, right, a salary that fits what the position is, and then the majority is also paid out through dividends, right, at a lower tax bracket. So when you do this, you can get taxed by your salary amount, but then you can pay yourself out in dividends, essentially a bonus that is taxed at a much lower rate. So the laws, honestly, it's not abusing them, it's just doing it in the favor of how they're structured, okay? The dividend income that I just talked about is not subject to self-employed taxes, self-employment taxes, which saves, another 15%, give or take. So that's what I'm talking about. That's the bigger structure, and I always recommend the S corp product, the S corp versus just the LLCs. That's how I hold all my properties and things like that. I'm doing underneath my S corp. Let's go to that last one. Talk about this: investors. The last category. So, for example, if you're an employee or self-employed, like we talked about, you invest your income in real estate. Let's say you sell that same real estate year after for a profit. You take advantage of the capital gains tax at a much lower rate. But what exactly is capital gains tax? Okay, that's the key to all this, which I'm hoping it doesn't go up, but they're talking about it with this administration that's coming in. According to law, right, you have to pay no taxes on the value of your earnings from the property. Say you make a flip, or you hold a property for a certain period over 12 months, you have to pay at 20% roughly is the capital gains tax right now, and that could go up, but that's what you're paying tax on. It's capped at its highest amount. So that's what I'm talking about on a long-term investment versus short-term. Long-term over 12 months, you have a capital gain tax. That is key. That's what basically generates investment. People want to invest, and that's what the advantage is. So hopefully don't change that, because it's going to push back on people wanting to invest. So to put this all in perspective, let me tell you a story. We all love McDonald's, right? We know that brand well. It's a huge brand. McDonald's, as you might know or might not know, makes most money from real estate. It's true. Okay, McDonald's works on the concept of franchising, except they invented this genius model when they bought the land that the franchise is sitting on. And so the owner of that McDonald's franchisee then pays royalties and rent to McDonald's for not only using the brand name, but also using the land that it sits on, their business. So I always knew that there was something, to that, model that just blew things up, and they really paved that way to make this work. I mean, it's genius. But everything you learn in this video is technically, it's true from how that's structured. People are doing it, but they're doing it legally, taking advantage of those loopholes that are in our system. However, to recommend, obviously, to consult a professional tax, individual, CPA, on these things. I'm not, providing tax advice or anything like that, but I just wanted to kind of share the different ways people are helping shield their taxes. So obviously, make sure you are doing that, seeking out advice. I hope you guys learned something from today's video. If you already haven't done so, then hit that button. Let us know that you liked the video or you didn't. And yes, you're more than welcome to leave your comments below, because I want to put a lot more videos out on these things, right? I'm on entrepreneurship, finance, just money in general, okay? Because what I'm doing is all about simplify the idea of money and how we can all kind of get ahead the best we can. So until next time, guys, I'll see you later.